Every economic crisis looks like a failure. Markets crash, jobs disappear, governments panic, and somewhere, quietly, someone gets very rich. Not accidentally, not later, right in the middle of the chaos. That's the uncomfortable truth most explanations avoid. Because if crises were just mistakes, they wouldn't keep rewarding the same kinds of players over and over across decades, countries, and systems. And right now, with global debt at record highs, interest rates reshaping entire economies, and financial stress hiding behind optimistic headlines, this question matters more than ever. So let's talk about who wins when everything breaks, and why the system makes sure someone always does. At first glance, an economic crisis feels random. A housing bubble pops, a bank collapses, a virus shuts down the world, a war disrupts supply chains. The story we're told is simple. Nobody saw it coming. Everyone suffers together. Recovery is about rebuilding. But that story skips the timeline where the real money is made. Because crises don't start when prices crash, they start long before, when incentives quietly line up. Here's how it actually works. In good times, money flows easily. Credit is cheap. Risk feels distant. Asset prices rise. But not everyone is rising at the same speed. Large institutions, banks, funds, corporations, borrow at lower rates than households ever will. They get early access to capital. They can absorb losses longer, and most importantly, they know the system will protect them. That protection changes behavior. When risk is privatized, but failure is socialized, taking big risks isn't reckless, it's rational. Then something breaks. Suddenly, assets fall, liquidity disappears, fear replaces optimism. This is where the crisis becomes profitable. Because prices don't fall evenly. People who need cash now, workers, small businesses, over-leveraged households, are forced to sell. Homes, stocks, entire companies. Not because they're worthless, but because time runs out. Meanwhile, the players with access to credit are still liquid, or they're made liquid. Central banks step in, interest rates are cut, emergency lending facilities appear, trillions are injected, not evenly, but through financial institutions. This is the part rarely shown on the news ticker. Money enters the system at the top first. Banks stabilize before households, markets recover before wages, asset prices rebound while unemployment is still rising. In the 2008 financial crisis, U.S. household wealth collapsed, but within years, stock markets hit new highs. In the pandemic crash of 2020, millions lost jobs. At the same time, global billionaires added trillions to their net worth. This wasn't because they worked harder during the crisis. It was because they owned assets that were protected, repriced, and reflated. Here's the uncomfortable math. If you own assets and can survive the crash, you benefit from volatility. If you rely on income and have no buffer, volatility destroys you. Crises transfer ownership, from the leveraged to the liquid, from the impatient to the patient, from the many to the few. And the system quietly encourages this. Publicly, crises are framed as disasters to be fixed. Privately, they are stress tests that consolidate power. Governments talk about saving the economy. Markets talk about opportunities. Both can be true at the same time. There's a subtle irony here. We're told that stability is the goal, but the financial system is designed to survive instability, not eliminate it. Volatility just reshuffles the hierarchy, and every rescue sets expectations for the next crisis. If large institutions expect support, they price that safety into their risk-taking. If markets expect intervention, they recover faster than the real economy. If inequality widens after every shock, the next crisis starts from a more fragile base. Zoom out far